This is lecture 11, Inventory 1. Okay, so obviously we are going to be talking this lecture and next lecture about inventory. Inventory is essentially goods held for sale to customers, right? So it's something that we sell to our customers. I talked about in the beginning of the class that there were two kinds of businesses that sold goods and businesses that sold services. So inventory are the goods that we're selling. So for a business that sells physical products, right, the inventory is the products they're selling. So for example, the campus bookstore, their inventory is all of the textbooks in the store and the school supplies and the Spartanware and all that kind of stuff. So the problem is with these kinds of businesses, we have this extra account to keep track of, this extra asset, inventory. So let's see how that works. All right, so going back to the bookstore, the campus bookstore sold a textbook to a student for $250 cash. The book cost the store $175 to purchase from the publisher. Okay, so we're going to work on what the journal entry would be. Now, the obvious thing here is $250 cash. So the bookstore is going to receive $250 cash. And they're receiving the cash because they did something for a customer. So the credit is going to be revenue. But instead of calling this service revenue, which is what we've been using so far, we're going to call it sales revenue. And the difference with the word sales is that we sold a physical product, whereas service revenue is if we perform a service. So if I sell an item, it's sales revenue. If I perform a service, it's service revenue. But either way, it's the same concept. They're both revenue. So this is essentially the entry we've already learned, right, of what happens when you do something for the customer and earn revenue. However, we have this new account to think about, inventory, which is an asset. So when we sell the textbook to the student takes the textbook and leaves the store with it. So our inventory asset goes down. So we are going to have a second journal entry with a credit to inventory. And that credit will be for $175, which is the cost of the book, the cost of the asset, right? This is the historical cost, what we paid to acquire it. Now, if the asset goes down, essentially the inventory is being used, right? That's the whole purpose of inventory, is to get sold to customers, right? So we have used it. That means we're going to have a debit to an expense, right? Because we've used up an asset. That expense has a fancy name. It's called cost of goods sold, right? Now, it doesn't have the word expense in it, probably because it's already a long name. Cost of goods sold expense would just be way too long. So we don't generally put the word expense there, even though it is an expense. And we just call it cost of goods sold. So cost of goods sold represents exactly what it says. It is literally the cost of all of the inventory, in other words, all of the goods that have been sold to customers during the year so far. So essentially, I didn't talk about this kind of stuff at the start of the course because we have two extra accounts to keep track of when we sell physical products. We have inventory and we have an expense, cost of goods sold. Now, we have two different ways that we can keep track of our inventory and of our cost of goods sold. Two methods. And these are known as the inventory recording methods. Remember, in accounting, recording means making journal entries. So first, we have the perpetual method. And the perpetual method essentially means that inventory is updated perpetually. Right? So the English word perpetual or perpetually means constant, all the time, never stopping. So we are making journal entries all the time. Essentially, what this means is that whenever we have any transaction that hits inventory or cost of goods sold, we update it immediately. So just like we did here in this example, right? The moment we sold the book, we had our journal entry and recorded it instantly. So no laziness here. We are automatically updating right away. Kind of like we do with cash, right? Cash is always updated right away. Now, this is the most popular method by a long shot for companies. It used to be not very popular back in the days before computers, because you can imagine back if you had to keep records by hand, doing journal entries every single time there was a sale would have been very tedious, right? So if I had a general store, I'd have cash coming in, but actually making a journal entry every time someone bought something to record what was sold would be a ton of work. So it wasn't something that most people used. However, the invention of the barcode made a huge difference to inventory systems, because by having barcodes, companies were now able to get things recorded immediately. So how does it work? Let's imagine that you want to go to the grocery store and buy milk. So you go to the back of the store, you pull out your milk, you take it up to the front of the store, right? And then you've got your cash register there. And what does the cash register do? What does the cashier do? Right? They scan the milk at the cash register, and you hear a little beep. And at some stores, right, you'll even see like a little screen there that tells you what was scanned. And it'll say 1 gallon Bay Farms fat-free milk, $3.99. Okay, so they have scanned the barcode and you've heard the beep. What has happened? Well, the beep indicates that the system has recorded that they are selling that milk. So in other words, when they scan the item, this journal entry is being performed, right? Before you even paid, right, the inventory system has recorded that it has been sold. Right? So every item that you purchase, every item that gets scanned, right, that is going into the inventory system before they even ask you for payment. So this is the perpetual method, right? The moment something gets sold, we update the records. So we scan it on the way out of the store and it gets updated. Now, the big advantage to this method, outside of having up-to-date accounting, is the information that comes with it. Okay? So for example, let's say that you are the dairy manager at Safeway. So you are in charge of purchasing all of the dairy products and making sure there's enough on the shelves. Now, you're going to have to purchase dairy products at least once a week, right? Because they expire. So it's that day in the week, you're going to order your dairy products and you want to know how much milk you should order. Now, this is actually a big decision, because if you order too much milk, well, then you'll have a lot left over and you won't be able to sell it and it will expire and go bad and you've wasted money. But if you order too little milk, you're going to stock out, and then customers will come to the store and they won't find what they want and they will be frustrated. And maybe in the future, they won't come back to your store. Okay, so it's a very fine balancing act. How much milk should I order? Well, in order to help me make that decision, right, I should take a look at my accounting records. I can take a look at my cost of goods sold records. How much milk did I sell last week? Right? And then maybe I can instead look and say, okay, how much milk did I sell this week last year? Maybe it's going to be extra warm this week. Temperatures are going to be very high. Do people buy more milk when it's hot outside? Well, I could look at my historical records, right? On weeks where the temperature was in the 90s versus weeks where the temperature was in the 70s versus in the 50s. How much milk are people buying? And I can use all of this data to help me decide how much milk I need. Now, of course, I may already have some milk. I probably do. So if I look at my inventory records that are totally up to date, I can see how much I have. And then I can take the difference between what I have and what I think I need, and that's how much I'm going to order. right? So having those updated records are very, very important because it helps companies make decisions and helps them run their business. So that is the big advantage of the perpetual method, is all of that updated information. Now, in comparison, the other way that you can do your inventory recording is called the periodic method. Now, periodic, as an English word, just means once in a while on a regular basis, right? So if I do something periodically, it means that it happens once in a while, but not all the time. For example, I am perpetually giving you homework, but periodically I will give you a test, right? So on a regular basis, every once in a while. So essentially, this is the lazy accountant's approach. Remember what we did with those adjusting entries with things like depreciation and prepaid expenses? We said, I can't be bothered. Let's just leave it and then we'll catch up at the end of the year. So that's what the periodic method does. The inventory and cost of goods sold are not updated until the end of the year. Now, if we're not keeping track of cost of goods sold and inventory, we don't actually know what's in there. So we don't actually know how much we've sold. We don't actually know how much we have left in stock. Right? So this can be a problem. But this method is much, much simpler, and it's less expensive to implement. The perpetual method requires barcode scanners, right? Special computers and cash registers and checkout stands, right? Those cost at least $30,000 or $40,000 to install. A cheap one might be $10,000. Now, that doesn't sound like too much for Safeway, but what about for a little corner store? Right? If I'm just opening my little corner convenience store, am I going to have an extra $10,000 to spend on a barcode scanning cash register? No, probably not. So if I don't have a lot of money, if I'm just starting out, if I'm a small business, I'm more likely to use the periodic method. Right? What about someone who doesn't have a cash register at all? Like, for example, I sell hot dogs from a cart outside the ballpark whenever there's a game. Okay, so I have a hot dog cart. I don't have a cash register. I'm not scanning barcodes whenever I sell something, right? So that's where I'll be using periodic method. The other reason companies might use periodic method is they might be a large company, but maybe they don't sell a lot of goods. So for example, take a hair salon. Hair salon's primary business is cutting and styling hair. That is a service. But every hair salon I have ever been to has that little rack right next to the cash register of shampoo and conditioner and styling products. And I have never, ever seen anyone buy that stuff, but every store has it. So some people must be buying that. But how much of it do they really sell? Maybe like 1 or 2 items a day? Okay, if I'm selling 1 or 2 items a day, is it worth putting in a big fancy barcode system and cash register scanner? Nope, probably not. So I may still have the periodic system just because in comparison to my total business, I have such a small amount of inventory and I'm selling so few items, it may not be worth it for the expense of setting up a perpetual method. Right? So these are the kinds of companies that would use the periodic method. But by far, the vast majority of companies that sell physical goods are going to be using the perpetual method. Now, with the perpetual method, when I get to year end, I can just look at my records. I know exactly how much I've sold and exactly how much inventory I'm supposed to have. But with the periodic method, we have no idea. So we have to use a formula to calculate cost of goods sold. So we say that cost of goods sold is the beginning amount of inventory plus any inventory we purchased minus the ending inventory. In other words, we start with a certain amount and then we buy more, right? Purchases. This amount, sometimes people call it goods available for sale, because this is the maximum amount of inventory that you can possibly sell, right? Whatever you started with plus what you purchased. So we take that amount and we compare it against the inventory at the end of the year. So the difference between all the inventory we had and what's left is what we sold. All right, now hopefully that makes intuitive sense, but even more, we've actually seen this formula before. We saw it with supplies. So if you remember, back when we talked about supplies, we said that supplies expense, so the expense was the beginning supplies plus the supplies purchases minus the ending supplies. We use this exact same formula. That's because supplies use a periodic system, right? With supplies, we're not keeping track of it individually during the year. We just kind of wait to the end of the year, see what's left, and then calculate how much we've used. So periodic inventory works exactly the same way, except instead of supplies, we're talking about inventory, the goods we're selling. Okay, now with periodic method, we know how much we started with, and we can probably figure out how much we purchased, but how do we know how much inventory we have at the end? Well, the only way to do that is to have an inventory count. So at the end of the year, we have to look at our inventory and count it to get this number. All right, so let's look at example 2. A company began the year with $50 of inventory. During the year, the company purchased $40 of inventory. At year end, they counted their inventory and had $33 left. Okay, so let's put this into our cost of goods sold formula. And we can determine that the beginning inventory we know is $50. We know that the purchases were $40 and the ending inventory was $33. So cost of goods sold is $57. All right, now let's compare that to the perpetual method. Under the perpetual method, technically we don't need this formula, right? Because we've been keeping track of our inventory and cost of goods sold. We have those up-to-date records that we're using to make our business decisions. So, hey, do I need an inventory count? All I have to do is go and look at my computer records. So, let's take a look. So I'm going to check my computer records, and they're going to tell me that my ending inventory is $35 and my cost of goods sold is $55. See? I already have it. Or do I? My records, my accounting records that I've been working hard and keeping up to date, they tell me my ending inventory is $35. But how much is actually there? Well, they counted the inventory. They physically looked at it and counted it, and there was only $33. Why is there a $2 difference? Why do I think I have 35, but when I actually go look at it, there's only 33? What could have happened to that $2 of inventory? So just to make it clear, that $2 difference is the difference between the 35 I think I have and the 33 that they actually counted. So what happened to that $2? Well, the fancy name for it is inventory shrinkage. Okay. So shrinkage is loss of inventory, inventory that disappears. And the most common reason for inventory disappearing is theft. Okay. Let's say I have someone come into my store and they take something using the 5-finger discount. All right, on the way out of the store, are they going to stop and make a journal entry and say, hey, I stole this candy bar? Probably not, right? So if something is stolen, whether by a customer or an employee or someone else, they're probably not making a journal entry to record that that inventory is gone. So what happens? Our inventory records still show that amount, even though physically, if we looked, right, it's not there anymore. So theft is one major reason for shrinkage. Now, the other possibility is something called spoilage. Spoilage essentially means inventory that gets damaged. Right? So this could be actual spoilage. So let's go back to that grocery store example, right? They have a lot of produce. So produce doesn't stay good forever, right? It can go bad. And, especially those 24-hour grocery stores, they have someone there in the middle of the night who goes through the produce and picks out all the stuff that's gotten brown or fuzzy or smushed or anything like that, right? So they take out all that bad produce. All right, what do they do with it after they take it out? Well, they throw it in the dumpster or maybe a composting bin or something like that, but basically it gets thrown away. Now, a minimum wage employee who's there at 3 a.m. pulling out brown bananas and fuzzy strawberries, is it possible that they may forget to write down how much they've pulled out, right? They may forget to make a journal entry. Yeah, quite possible, right? So spoilage, things went bad, we threw them out, so they're gone from inventory, but I didn't make a journal entry. So it's still in the inventory, but if you went to actually look at it, you'd see that it was gone. Now, it doesn't have to actually be expiration spoilage. It can be any kind of damage. So for example, let's say that I sell paper products, right? Pads of paper or paperback books or textbooks. And I have a whole bunch sitting in my warehouse, and one of my sprinklers goes off. And now I have a water leak, and all of my paper products get covered in water. All right, what happens to a bunch of paper when it gets soaked in water? It basically gets destroyed, right? So I may have a big mess at the end that certainly is not saleable inventory, and I've just got to toss it. Maybe I don't even know how much is in there. It's just a pile of stuff, and now it's a mess. So somebody goes in, they clean it up, they get rid of it, but they don't make a journal entry, right? So that can happen too. But the most common reason for shrinkage is theft. Okay, so under the perpetual method, we know that there's $2 missing, so we have $2 of shrinkage. What about under the periodic method? Are we missing $2 under the periodic method? Well, yeah, it's the same company, right? We are missing $2. But the difference is that under the periodic method, we don't know that. We have no idea that inventory is missing. The only reason we know it's missing under the perpetual method is because we are able to compare. We're taking our records that we've been keeping track of and comparing against the count. Under the periodic method, we have no idea how much inventory we're supposed to have. We just take that $33 and we assume that it was sold. So that extra $2 ends up here in cost of goods sold, right? This cost of goods sold is $2 bigger than the one down here. We just assume all the inventory that's missing was sold, and we have no idea that something was stolen. So another disadvantage of the periodic method, we don't have up-to-date information, and that means we have no idea how much shrinkage exists. So under perpetual, much better information, although obviously more expensive to set up the system, and we know about shrinkage. Now, is it helpful to know about shrinkage? Do I actually want to know how much is stolen or spoiled? Well, yeah, because if I know how much this is, I know when it starts becoming material. I know when it starts making a difference to me, right? If I'm only losing $2 of inventory, I don't really care. But suppose I'm losing $200 or $2,000. Well, that's going to start making a difference to me. And maybe if I'm losing $2,000 of inventory every month, maybe that starts paying for some deterrent measures. Maybe it pays for a security guard or cameras or bars over the door, right? Or maybe it pays for a locked cabinet so I can lock up the more valuable merchandise and I'll need an employee to open it up, right? Whatever the case, right? If I'm keeping track of shrinkage, I can try to do something about it when it gets to a point where I start really caring about it. So by knowing how much it is, I can then keep track of it and potentially do something about it. Okay, now what we are going to do is we're going to learn how to do the journal entries for inventory. Now here's the thing, even though periodic only does entries once a year, it's kind of a complicated set of entries because you've got to do all of the years updating at once. So it's not a simple thing. Perpetual journal entries, even though they happen more often, are simpler. They're easier to understand. On top of that, the vast majority of companies that you will encounter use the perpetual method. So for journal entries, I'm only going to teach you the perpetual method. Okay? And the reason for that is because it's by far the more common method that you'll see, and it's also the easier method. Now, if you go on to intermediate accounting into Biz 121A, there we also learn how to do the journal entries for the periodic method. So that's something we cover in our intermediate classes. But for this introductory course, we're just going to go with the most commonly used method for our journal entries. All right, so let's do an example. Okay, so a company has the following information for the year. And what we're going to do is show all of the journal entries for these transactions using the perpetual method. Okay, let's start out here at January 1st. Beginning inventory is $100. Okay, do I need a journal entry for that? Well, no, I do not. This is just the beginning amount. So the beginning amount is what carried over from last year, right? So this is what it was at the end of the previous year, and now I'm just saying this is my beginning amount. Any journal entries necessary to get this $100 in here, they occurred last year. So this is just my starting amount. I don't need a journal entry for it. Okay, but this rest of this stuff, we are going to need journal entries. So let's get going. March 15th, they purchased inventory for $350 cash. Okay, so inventory is an asset and cash is an asset. My debit will be inventory because inventory is increasing, and cash will be credited because it is decreasing. So on March 15th, right, we're going to debit inventory, increase it, and credit or decrease cash. Okay, next, on May 31st, we sold inventory costing $125 for $200 cash. All right, let's do the easy part first, right? The $200 cash. We know that we're receiving $200 of cash. All right, now, what's the credit there? Well, we're receiving cash because we did something for a customer. So we've earned revenue, and we're going to call that sales revenue because we sold a physical product. Now, in addition to this, we need to have a second entry to deal with the inventory part, right? Because the inventory has gone away. So we are going to have a credit or a decrease to inventory for $125. It's cost. Now, selling inventory, decreasing it like this, that is using it because its purpose is to be sold, right? So we've used the inventory. That means we need an expense, which is cost of goods sold. So this is the key thing to remember, and you'll want to remember this when you get to the test. Okay? When we're selling physical products, we have two journal entries to record a sale. We have a journal entry to record the revenue and a journal entry to record the expense, the cost of goods sold. With service revenue, we just have the first one. But when we're selling physical goods, we have two entries, one for revenue one for cost of goods sold. Now, sometimes students get confused. They're like, hey, there are two numbers. How do I know which one goes in which journal entry? All right, I'm going to give you a hint. This number here is the sales revenue. In other words, it's the selling price of the goods. This here is the cost of goods sold, the cost. This is what we paid for those goods. So generally speaking, which do you think would be bigger? Would it be the selling price, the revenue, or the cost? Right? Obviously, for a business that's making money, the selling price should be bigger than the cost. So typically the larger number is the one that we record as the revenue, and then the smaller number is the one we record as cost of goods sold. Okay, so that is for May 31st. Let's move on to August 31st. They purchased inventory on account for $15. All right, so inventory is being purchased. So again, we're increasing inventory, right? But instead, there's no cash this time, it's on account. So our credit is going to be accounts payable, increasing the liability. All right, next on October 31st, they sold inventory costing $250 for $340 on account. All right, so we sold inventory, it cost this much, and this is how much we sold it for on account. Okay, so there's no cash this time. This time we have accounts receivable, and that's an increasing asset. So we're going to debit accounts receivable. And of course, we got that because we did something for a customer. So we're crediting sales revenue. All right, now in addition to the sales revenue, we have to record the inventory and the cost of goods sold. So we're going to debit cost of goods sold, which is our expense, and credit inventory, our decreasing asset, for the cost of $250. All right, so you can see here in this example, I've only done it twice each, but you can see for a company, these are the two things that happen with inventory during the year, right? We buy it, we sell it. We buy it, we sell it. We buy it right here, and we sell it. So you can imagine a real company, these entries are going to occur many, many times throughout the year. Okay? But for this example, since I'm trying to keep it short, just twice. All right, last thing here on December 31st. The inventory count shows $80 in ending inventory. All right. Is that the right amount? I don't know. But this is the perpetual method. So we've been keeping track of our inventory. So all we have to do is go look at the inventory T account. All right, so let's take a look at our T accounts here. So I'll just show a few T accounts just for the things that are going to be helpful for us. So sales revenue. This is what's in sales revenue. We started the year with 0 because remember, revenues and expenses start the year with 0 because we closed them at the end of the previous year, right? So there was nothing in sales revenue to start, but we had $200 and $340 of revenue during the year. So that's there for a total of $540. Now, cost of goods sold. What's in there? Well, again, cost of goods sold is an expense. So there is nothing in there at the start of the year. But during the year, we debited for $125 and we debited again for $250. So we see those there. We have a total cost of goods sold of $375. Now, inventory. What happened there? All right, well, inventory has a lot more stuff going on. So let's see if we can keep track of it. Okay, so inventory, we started the year with 100, right? And I know that from back up here, right? Beginning inventory was $100. Then during the year, we increased inventory by $350 when we purchased it. And then we decreased inventory by $125 when we sold it. Then we increased inventory by $15 when we purchased it. And then we decreased inventory by $250 when we sold it. All right, so how much inventory do I have at the end of the year? All right, let's see here. We're going to have $90. Okay, is that the same as what our records, our count said? No, our count says we have $80 in ending inventory. So we have 90 here just from adding it up, but the count says 80. How is that possible? Well, the answer is there is shrinkage. We have lost some inventory. Okay, so when we prepare our balance sheet and we are showing inventory, how much do we want to show for that asset? Do we want to show $90, which is our total here after keeping our good records all year long? Or do we want to show $80, which is the amount in the count? All right, the answer is we're going to show $80. Partly, it's more conservative, right? We're going to make sure we're not overvaluing the inventory. But more importantly, it's the most accurate inventory number. We counted it. We physically looked at it and verified it. That's about as good as you're going to get in terms of having an accurate number. So it's actually required that we have to use the count number. So we have to use the $80 count. All right, the problem is the inventory T account right now says 90 in it. So what are we going to do? Well, we're going to have $80 as the total. So to get from 90, which is what we had when we added up, to 80, which is the count, that's the total we want, we are going to have to credit or decrease inventory by $10. All right, so on December 31st, we do have one more journal entry. We are going to have to credit inventory by $10. All right. Now, why do we have less inventory? Where did it go? Well, that was shrinkage. So the debit is going to be shrinkage expense. So on December 31st, we're going to have our $10 credit to inventory, which we can see here in the T account, right? And that was because of shrinkage expense. All right. Okay, now we know what our numbers are at the end of the year. So let's say that we want to make an income statement for this company. Now, obviously, we don't have all of the information, but let's just take a look at what this information would look like on the income statement. So first, we're going to have our sales revenue. Excuse me. Okay, so sales revenue is $540. We know that from the T account. Now, next, we're going to have our expenses subtracted. But here's the thing. We have this new expense, cost of goods sold. And cost of goods sold is a very fancy expense. It has a fancy name. It can't even be bothered to put the word expense in there because it has such a fancy name. Cost of goods sold is a hoity-toity expense. It thinks it's better than everyone else. And what do you do if you think you're better than everyone else? Well, you get to go first, right? You are always first in line. And that's what happens with the cost of goods sold. It is the first expense listed. So it always comes right after the sales revenue. So we're going to show the cost of goods sold right here. It's the first expense listed right at the top. Now, of course, when you're hoity-toity and you're better than everyone else and you go first, you're going to stay first. You can't be mixing with the rabble. So what do the celebrities do when they think they're better than everyone else? They go into the club first and they set up that velvet rope, right? So they say, hey, you can't come past this. We're on this side and you're on that side. So that's what happens with the cost of goods sold. It doesn't want to mix with the other expenses. Even if it goes first, it doesn't want to mix with them. So it sets up a velvet rope, and it does that by having a subtotal. So what we do is we add the sales revenue and the cost of goods sold together, and we come out with a number, which in this case is $165, and we call that gross profit. All right, so I know this looks like a contra account thing, right? Because we have something minus something in a total. It's not a contra account. This is a revenue, this is an expense, and here, this is just a subtotal. After this, we get on to all of our other regular expenses. So we are going to have our other regular expenses, one of which will be shrinkage expense. Okay? And then finally at the bottom, then we get net income. All right, so when we have an income statement with inventory and cost of goods sold, right, the big difference is that cost of goods sold is listed first, and there is a subtotal after it. Then we just list all the rest of the expenses, including shrinkage expense, as normal, and then get our net income. Okay, now I was making a silly story, right? Okay, cost of goods sold is special. It has to have a velvet rope. It has to be separate from the rest of the expenses. Realistically, why do we have this subtotal, gross profit? What's the point? Okay, this goes back to the discussion we had about gross and net, right? Gross profit. This is the total profit. This is the intuitive level of profit. It is the selling price compared to what we paid for the products, right? So let's say you sold something on eBay and I said, hey, how much profit did you make? You'd say, well, I got it for 50 bucks and I sold it on eBay for 80 bucks. So I have $30 of profit. All right. Let's say you went to a high school and there was the football team and they were having a bake sale so that they could take a trip to an away game. Okay, so you go up to the people at the bake sale and you say, hey, how much profit have you made at this bake sale? How are the high schoolers going to calculate their profit? Okay. Well, they're going to say, hey, this is the amount of money that we took in from people who bought stuff, our customers, and this is what we had to pay to buy all the baking mixes and stuff in the first place. So here's our profit. Okay. So even people who know nothing about accounting, they have that very intuitive level of profit, that intuitive concept. They say, look, let's compare the selling price against what we paid for the item, right? That's our profit. Okay, so that's easy, that's intuitive, but even after only a few weeks of accounting, you already know that's not accurate because there are other costs, other expenses that have to take place to run our business. It's not just comparing the selling price to the cost of the item. We have to pay for rent, we have to pay for insurance, we have to pay for utilities, we have to pay for salaries for employees. There's depreciation, there's all this other stuff we have to pay for. So we have all of these other expenses that come into play before we calculate the true profit, which is net income. Okay? So gross profit is our intuitive base level of profit. Net income is our net profit after we've subtracted all of these other expenses that people may tend to forget about. Okay, so we have the gross profit or income and the net profit or income. This being said, even though it's not the whole story, a lot of people still find this number useful, partly because it's that intuitive number and just because it's a direct comparison of selling price to cost of the items. If we're not generating gross profit, there's no way the company can make money. So, it's that very basic level of profit, and people find this a useful number. So that's why we have this little subtotal. Is because this is a useful amount to see. But of course, it's not the real profit. We still have to look for net income to be our real profit. Okay. All right, so gross profit is the base amount of profit that the company is making before applying all of those other expenses. Okay. Now, we've known that we have inventory, and we know that we're going to record inventory at its cost. But does the value of inventory stay the same forever? Right? If I buy inventory, is it always going to stay at the same value? Well, no, right? Some items, some inventory changes in value. For example, if I have a gas station, the price of oil and therefore the price of gasoline changes every single day, right? It changes throughout the day. So just because I bought inventory a week ago doesn't mean that it has the same value today. Other times, right, we may have items that change value just because, something happens. So let's say that I purchased inventory for $200. Okay? And when I get to the year end, I still have that inventory. And my selling price on it is $300. Okay, so what value am I going to use for inventory on my balance sheet? Well, I'm going to use the $200, right? My original cost. Right? Makes sense. $200 is consistent with the historical cost concept, and it's also conservative. I'm not going to use the $300 selling price because that would be overvaluing my inventory. I want to make sure I go with the lower value so it's not overvalued. Okay, now let's take a look at a different situation. Let's say that I have high-tech inventory. So I am selling laptops or mobile phones or adapters for various devices. Right? All of the high-tech products. The problem with high-tech products is they decrease in value over time. Okay? So for example, I want a brand new iPhone. I want the best there is. I go out, I'm getting an iPhone 11. But in the fall, they're coming out with a new iPhone, which is going to be iPhone 12. All right, what just happened to the value of my iPhone 11 once they announce that new one and the new one comes out for sale? Well, the value of my phone has just dropped. And this is typically what happens with high-tech products. We often see that they are dropping in value because the new products come out so quickly and replace them, and then they get less valuable. So we can have high-tech products that cost a lot of money, but 6 months or a year later, those products cost a lot less. So let's say I'm selling a product like that. I bought the product last month for $200, but now, this is selling price, not a price, but now that product is selling for $160 because it has dropped in value. Okay, which value am I going to use for my inventory at year end? Am I going to use the $200 cost or the $160 selling price? All right, well, using the cost would be consistent with historical cost. But the 160 is more conservative. If I use $200, I may be overvaluing my inventory, right? Because it's not worth that much. I can only sell it for $160. So which value should I use? Well, the answer is we have two conflicting concepts. We have historical cost conflicting with conservatism. We need to make a decision as to which one is more important in this case. And the answer that GAP decided on is that conservatism is more important, that we're going to use the $160. Okay, so the rule for this has a fancy name. And the name for the rule is exactly what the rule is. We call it the lower of cost and net realizable value. So it means that we have to record inventory at the lower of cost and net realizable value. Now, I know that's a mouthful. It's a really fancy term. Essentially, net realizable value means selling price. So inventory is recorded at the lower of the cost and the selling price. So back up here where our inventory, we could sell it for more than we paid. And that's the normal situation, right? That's what we hope most of the time happens. Inventory is valued at cost. But if we end up in a situation where our inventory is just dropping in value, we're going to sell it, we're going to value it at its selling price. Okay, so if we think about this situation, right? The T account for inventory, I'll put that on the next page. Okay, the T account for inventory has $200 in it because that's the cost, right? That's what we paid when we purchased it. But we want to have $160 in there at the end of the year. So how are we going to get from 200 to 160? Well, the answer is we are going to have to credit for $40. All right, so we're going to have to make an adjusting journal entry for that. So we're going to have to decrease or credit inventory by $40, and the debit goes to holding loss. So this is a loss on the income statement. So remember we talked about losses last class. So it's a loss, and we call it a holding loss because we have it because we held on to our inventory for too long. So instead of selling it quickly, we held on to it and we lost money. So that's why it's called a holding loss. Okay, let's take a look at example 4. Ike Company has inventory recorded at a cost of $325. The net realizable value, in other words, the selling price of the inventory at year end is in A, $340 and in B, $320. Okay, so we are going to make their lower of cost and net realizable value year-end adjustment for each of those two situations. Okay, so in our first situation, A, we have a cost of $325 versus the selling price of $340. So which one are we going to use? Well, we're going to use the lower one, the $325. All right, so using the $325, right? How much is in inventory already? Well, inventory is already its cost of $325. So we don't need to do anything. We're going to use the $325. It's already there in inventory, so there's no adjustment necessary. Right? This is what happens the majority of the time, right? Most companies, the selling price is higher than the cost, and so we don't have to do anything. No adjustment necessary. But what about those situations where our inventory has just fallen in value? Okay. So that's what we have in part B. So in part B, the cost is $325, but the selling price is $320. So which one are we going to use? Well, we're going to use the lower one, which is the $320. All right, now, if we're using $320, right, how much is in the T account right now? Well, what's in the T account is $325. So we're going to need to make an adjustment. All right, so let's take a look at that inventory T account. We know there's $325 in there because that's the cost, but what we want at the end is $320. So what we're going to have to do to make that work is we're going to have to credit inventory for $5. So we're going to have a journal entry where we credit inventory and we debit holding loss. Okay, so that's what we do in the situation where inventory's value has dropped and dropped a lot. Doesn't happen that often, but mostly I just want you guys to be aware that we have something that deals with that, and that if the inventory value drops that much, we actually decrease the inventory. Okay, last thing I want to talk about this morning is a couple of financial ratios. So we talked about a few financial ratios last time. Let's talk about a couple more today that relate to inventory. So the first one I want to discuss is one called inventory turnover. And it is calculated as cost of goods sold divided by average inventory, right? Where average, just like in the days sales ratio last time, average means the beginning amount plus the ending amount divided by 2. Okay, let's calculate the inventory turnover for this company back here that we did back in example 2, or actually example 3. Okay, so we're going to do their inventory turnover. So the inventory turnover, we need to know the inventory balances. Well, it started at 100 and ended at 80, right? And the cost of goods sold was $375. So if I fill in those numbers for that company, we have $375 of cost of goods sold, and the inventory had a beginning balance of 100 and an ending balance of 80. Then we multiply by 1/2, that's the same as dividing by 2 to get our average. So our inventory turnover is 4.17 times. Okay, what does that mean? It means that inventory turns over 4 times a year. A turnover means that we stock up with inventory and then completely sell it out. So an inventory turn is we stock up with inventory and then sell it completely. So how many times a year do we have to purchase inventory and then sell it all, and then purchase inventory and then sell it all? Now, this is very, very, very dependent on the industry, right? Certain industries have a lot of inventory turnover and some have few. Now, in this example, we have about 4 times. That would be something like a clothing store. So think about a clothing store, fashion, right? We have seasons in fashion. We have spring clothing, summer clothing, fall clothing, and winter clothing. So your store in the mall is going to stock up with spring clothing. And then they're going to sell all of that spring clothing and stock up with summer clothing. And then they'll sell all of that and stock up with fall clothing, and so on. So roughly 4 times a year, they're getting in a new set of inventory and selling it. Now, what about the grocery store? I've brought that up a couple times this morning, right? So let's think about the produce or the dairy. How often do they have to buy new produce or new dairy? I'd think at least once a week, right? To keep it fresh. So if they're buying inventory and selling it once a week, then their inventory turnover is going to be 52, right? What about a car dealership? A car dealership, how often do they get new inventory in? Well, just once a year, right? So in 2020, they have all the 2020 models and they sell them. And then at the end of the year, they get the 2021 models, right? Once a year, we get that new inventory and sell it. So for a car dealership, this is going to be a lot closer to 1. right? So this is very industry dependent, but basically it tells you how quickly a company is buying and selling inventory. How often does inventory cycle through their company? Okay. All right, and the other ratio I want to discuss is something called the gross profit percentage. Now, the gross profit percentage, the official formula is that it's gross profit divided by sales revenues. But remember, gross profit is sales revenues minus cost of goods sold. So you can think of it that way as well. Okay, now again, let's go back to the company here that we used in the previous example, and we'll calculate their gross profit percentage. So their gross profit is $165 and their sales revenue is $540. So their gross profit percentage is going to be 30.5%. Okay, so what does that mean? All right, well, let's take a look at this here. Their gross profit percentage. Let's imagine that sales revenue is 100%. The amount of sales revenue that makes it down to gross profit, we've just learned, is 30.5%. So in other words, approximately 70% of their selling price is cost of goods sold, and 30% of their selling price is gross profit. Or think of it another way. For every dollar in revenue, we have 30.5 cents of gross profit. All right, now this percentage here is something that is used in businesses for many different things, but often to help set selling price, right? Often companies will want to make a set amount of profit, a set percentage, and they will set their selling price based on that percentage. So for example, that gas station, right? Gasoline. The price of gas changes every day. Why does the price of gas change every day? Because the price of oil changes every day. And that means the price of purchasing gasoline changes. Most gas stations want to have a set percentage profit. So if their cost of goods sold goes up, they have to raise their selling price in order to keep this percentage the same. Now, even more importantly with gross profit, we can use it to make decisions about which products are profitable and which products we want to use. Let's say I have a company and I am making 10 different products, but I'm running out of capacity in my factory. I've got to drop one of my products. Which one do I want to drop? Well, I'll probably drop the one that has the lowest gross profit percentage, the one that's going to make me the least amount of money. So I can calculate this individually for every single product that I sell. Sometimes companies use this as a strategy. For example, let's take Nintendo. They make the Switch. So let's say you want to buy a Nintendo Switch. How much gross profit percentage do you think they're making on the Switch itself, on the actual machine? All right, well, the answer is very, very little. This is an extremely low gross profit percentage. All right, so they're making almost no money when they sell the Switch itself. Where do they make their money? They make it on the games, right? What is the gross profit percentage on the games? Well, the profit percentage on the games is close to 100%. If you have a download, right? You buy the software and you just download it straight to the Switch, it is 100% profit, right? But suppose you go old school and you actually buy the box that has the little chip in it, right? Okay, so you're buying the box and the cartridge. How much does that cost to manufacture? right? Maybe $1. So you're buying a game for $60 and it maybe costs $1 to manufacture the box and the cartridge. That's still a huge gross profit percentage, like 98% or something like this. So that's how Sony operates, right? They sell the hardware for very cheap, very low gross profit percentage, and then they sell the games for a very high gross profit percentage. There are other ways that companies use gross profit percentage to make business decisions. And the most interesting example is with a grocery store. So I'm going to do a new screen share here. I'm going to try out the whiteboard. All right, and we're going to share that. Okay, so imagine a grocery store. So here's my fabulous mouse drawing for you. All right, so this is a grocery store. Here's the front door. Imagine every grocery store you've ever been in. Let's say you want to buy milk. Where is the milk? All right, the answer is the milk is back here, or maybe it's back here. It's in the corner. All right, now, most grocery stores will sell milk for a 0% gross profit. They will sell it at its cost. All right, why do they do that? Why would they sell milk below cost? All right, well, here's the answer. Demand for milk is pretty much inelastic, right? From economics, you remember that means that the demand for milk is not going to change. People want it no matter what, okay? But that means they have to go into the store to get it. And milk expires, so they have to come into the store regularly to get milk. Okay, now let's think about what else is in the grocery store, right? Back here, you're going to have your meat counter, right? And over here, you're going to have your deli and your bakery. And over here, you're going to have your produce. Maybe the produce and the bakery are switched, but basically you're going to have those on the sides with the meat way in the back. Okay? If you've ever heard the expression that if you want to eat healthy, eat around the outside of the grocery store, right? That's why. Because what's in the middle? What's all of this stuff here in the middle of the grocery store? It's all of the processed foods, right? All of the stuff in boxes or cans, all of the stuff that's prepackaged. All right, now, they make no gross profit on the milk. They make a small amount of gross profit on the meat, on the produce, on a little more on the bakery and the deli. But this stuff here in the middle, this is where they make their real money. They are making about 10 to 20% gross profit on all of the stuff in these aisles. And if you happen to go down the pet food aisle or the drugstore aisle, you know, where they try to sell you the drugstore products, they're making like 25% on that stuff. So their whole goal is to get you to come in and get your milk. But as you do that, you have to walk through all these aisles and then you have to walk back. And they're hoping you're going to pick up a whole bunch of other stuff, maybe on impulse, maybe because you need it. But that's why they sell milk at such a low price and how they make their money. So a grocery store has actually laid out the entire store based on gross profit percentage. So, that is just another example of how this can be used. Okay. All right, so let's go back here. The whole point of this is that gross profit percentage is a useful tool for running a business. So this is a ratio that if you run your own business, you might very well end up using a lot. Okay, so that is our material for today. We have homework, which is due on Tuesday. So in chapter 5, I'd like you to look at questions 1 and 4. And next time, we're going to talk more about inventory and what happens if we purchase bunches of inventory at different costs and how we deal with that. So until then, stay healthy, and I'll see you next time.